Are you absolutely sure that the figure is correct? There are definitely losses of 1 billion. Combining despair and hope at the same time, the management of Royal Dutch Shell, one of the world's largest oil companies, was waiting for an answer from its Japanese subsidiary Showa Shell in 1993. No matter how incredible this amount may seem, it was really so. And all this because of speculation in financial instruments. No, of course, the Japanese did not want to speculate. They had a specific problem, and they wanted to solve this problem. And the problem was the yen-dollar exchange rate. Showa was an importer. They bought crude oil abroad, then processed it and sold it in Japan to end consumers. This means that they incurred expenses for the purchase of imports in dollars and received income in yen. And any fluctuation in exchange rates could both give additional profit and create a loss for the company. Let me explain how it worked in practice. The company could buy oil either on the spot market or under a long-term fixed-price contract from the parent company. And the financial risks were as follows. The company's oil refining capacity was 500,000 barrels per day, which meant that the company could import 15 million barrels of oil each month. At that time, Texas Intermediate oil was worth $20 per barrel, and that meant that the company had to spend $300 million to buy this volume. Now look, since the company receives income in Japanese yen, the company needs to convert this yen into dollars every month, and the exchange rate does not stand still. Today it is 145 yen, in a month it is 150, and in a month it is 140 yen per dollar. And here the next problem arose. Gasoline prices at that time were controlled by the Japanese government, and the company could not change them in response to market conditions. And if the company received 44 billion yen in revenue last month and the exchange rate rose to 150 yen, then the next month they had 45 billion yen in purchasing costs. And this means that the company's loss is 1 billion yen, or about $7 million. Of course, when the exchange rate fell, the company was already making money from exchange rate differences. But shareholders didn't really like such currency swings. Therefore, in order to somehow stabilize income, the company decided to hedge this risk with a forward contract. A forward is an obligation to buy or sell an asset at a predetermined price. In this case, it is $1. Well, for example, if at the time of the transaction the yen rate was 145, then in 3 months it could buy $1 at the same price, regardless of what the exchange rate was at that time. In general, the Japanese calculation was logical. After all, in 1985, Japan signed the Plaza Accord, and since then, the Japanese yen exchange rate has grown significantly. And then indeed, many believed that the Japanese currency had reached its maximum value and would not grow anymore. Therefore, everyone was waiting for a certain rollback and devaluation. Moreover, the fact of devaluation to 160 yen took place in 1990. The problem itself was that there is a very thin line between hedging and speculation, which is very easy to cross. And the Japanese themselves did not notice this, as instead of hedging, they began to bet on the exchange rate in order to earn on forwards. These bets were the reason for further losses on forwards, because contrary to forecasts, the exchange rate continued to strengthen. And from 1990 to 1993, the yen exchange rate strengthened from 160 to 100 yen per dollar. For Showa, these were actual losses on forwards, because they had to buy $1 for $150, although its price on the market was only $100. The problem was also exacerbated by the stubbornness of the Japanese in wanting to recoup their losses. After recording the first losses, they began to double their positions, waiting for a devaluation in order to recoup their losses. The devaluation did not happen, but they did lose $1 billion. Another interesting thing here is that the yen to dollar exchange rate returned to 145 in 1997. It is not for nothing that there is a saying on the stock exchange that you can run out of money before the market goes in the direction you need.